I thank each of the panelists today. We'll now turn to member questions, and I recognize myself for 5 minutes for questioning. When President Trump, in his first term, signed S-2155 into law, there was broad at that time bipartisan recognition from Congress that the federal banking supervisors needed to tailor their rules based on an institution's size, complexity, and risk profile. I want to applaud each of you and your work in your agencies for your continuing effort to return to this standard, which was regrettably rejected by many of the supervisory leaders in the Biden administration. Vice Chairman Bowman, the committee recently sent a letter to the regulators to support what you're doing using your existing statutory authorities to further tailor the application of enhanced prudential standards for Category 2, 3, and 4 banks, as well as to index regulatory thresholds for those categories. Is this something that you expect and your colleagues to undertake, and what are you thinking about as terms of sequencing that and the timing?
Thank you, Chairman Hill. That's a very important issue, and I think over the years I have strongly supported the concept of tailoring regulation to the size, complexity, and risk of institutions. I do plan to review our tailoring framework and our approach to ensure that it has the intended effect that Congress intended in S-2155, and we are evaluating indexing the thresholds as we're considering broadly our work on the regulatory framework.
Well, in the past, Reg YY, which outlines the capital planning thresholds, I think the last time President Trump was in office, the agencies agreed to do it periodically, that they would review that indexing. Do you think Congress should set that it be done automatically with inflation or some other? We seem to spend a lot of time here debating that, and shouldn't it just be regularly reviewed by statutory agreement and indexed, maybe in accordance with inflation? Would that be better, you think?
I think that indexing is a critical part of the regulatory framework. We've seen incredible growth in the money supply as well as the assets of the banks over the last few years. In fact, during COVID, there was an exponential growth in the size of financial depository institutions. So it would be helpful to have a regular cadence for reviewing those thresholds, and I think it's appropriate that we do so now.
Thank you. Acting Chairman Hill, we talk a lot in here about exam appeals and the opportunity for a management team and their board of directors to appeal an exam finding if they thought it was done in an unfair manner in some manner. Goes back to my ancient days at Treasury. By the way, Hamilton was a great secretary. But in 1994, the Regal Act promised this as a part of regulatory reform then, and it really, an independent process just was inconsistently applied, I would say. Mr. Scott, my friend from Georgia, and I have a bill called the Fair Exams Act that we believe would give teeth to that Regal promise back in 1994. I know you've taken steps to revamp the supervisory process, but do you think this should be clearly outlined in statute by the Fair Exams Act?
I think additional clarity from a statutory perspective would be very helpful. So would strongly encourage Congress to continue to look at that.
Thank you. We had a hearing just a few weeks ago on deposit insurance, and we appreciate you and your staff's work with the committee extensively on the topic of deposit insurance, which is of keen interest to the ranking member and myself. I'd like to ask a few questions about your views on the FDIC's reserve ratio for the DIF. It's a pretty straightforward formula that you have a statutory responsibility for. What is the requirement, the minimum reserve ratio?
The reserve ratio is defined as the net worth of the deposit insurance fund divided by insured deposits, and the minimum ratio set by statute is 1.35%.
So let's say we raise the deposit insurance coverage amounts 100 times to what it is now, meaning the denominator goes way up. Normally, for the FDIC to meet its statutory minimum, wouldn't it need to raise assessments as well?
If no other changes are made and the denominator goes up, then that's correct. In order to achieve the same reserve ratio, the revenue coming into the DIF would have to increase.
Yeah, so it seems like, and if they don't collect the revenue to meet the reserve ratio minimum, that could be, put the diff at some risk. Do you agree or disagree with that?
I think that's a complicated question, and happy to go into some of the considerations. I know the time is short here.
We'll continue the discussion. Thank you, and thank the panel.